Hello, thank you for having me. It's brilliant to be here. As mentioned, my name's David. I'm a partner with McKinsey & Company. I do two things. I coordinate our work with development finance institutions globally, and I also lead the Manufacturing Africa program along with the FCDO, who will sit over there and be delighted to tell you about the program. So I have two pieces of excellent news. First, the Invest Africa team, when they asked me to lead this session, told me it was going to be the best panel session of the day. So they're very charming, and I'm sure it will be. Second, after this, we're going to break for tea in a very English kind of way. So we will try to keep the time to enable you to get your tea. So the reason it is, I think, going to be such an interesting session is we have an amazing panel who I'm going to invite to come up now. And it says pause for applause for the panel. And they are genuinely, I think, going to be an amazing panel. And then secondly, because the topic we're going to focus on, redefining development finance, is both important and interesting. And I think based upon the discussions we've had today, it's one on which basically everyone has an opinion, but no one can agree on the solution until now. I'm confident the panel is going to land us on the solution. So I think the starting point is pretty challenging, or if you're an investment banker, full of opportunity. Africa's, as we've heard today, Africa's finance needs are growing, but the traditional development finance model is under pressure and arguably isn't working properly. Again, the panel, I think, will have quite strong views on that. Aid budgets are contracting across many donor countries. African governments face severe debt burdens, which in turn are crowding out investment, infrastructure, health, education, and growth more generally. And DFIs are being asked to do more, mobilize more capital, take more risk, support more transformation. Often with less fiscal and political headroom, or at least different political objectives. I suspect, and this is what I think we've heard today, is that means we need to mobilize more private capital, we need to mobilize more domestic capital, and we need to align it better with Africa's priorities. So we want to focus today's discussion really on solutions. How do we make development finance work better? So I'm going to sit down in a second, and I'm going to ask each of the panel members to introduce themselves, a bit about your role, the institution you work at, and then summarize for us, what's working today, what isn't working today in development finance, and particularly focus on from where you sit. Some of you are bankers, some of you are investors, some of you are in DFIs. What are the game changers? What needs to be different? And I'm going to ask you, Leslie, to start us off.
Thank you very much. My name is Leslie Marstorp. I am Chief Executive of British International Investment. It's the development finance institution of the UK government. BNI is also the oldest of the DFIs, having been created way back in 1948. But in our modern incarnation over the last 25, 30 years, I would say the institution has really sort of graduated into a leading, I would say, market builder, sort of ecosystem builder, especially in the African continent, but also in Asia. One of the things that distinguishes development finance institutions is that we classify ourselves as long-term patient capital, which means that we are able to take a longer-term horizon than traditional investors, some of you sitting in the room. As a result of that feature, we are able to do things like, for example, in the African continent, BII or CDC, as we were known before, is one of the critical anchor foundational investors in creating the venture capital industry, in creating the private equity industry. Many of the funds sitting here in the room were indeed, we were the first LPs investing in those institutions when they did not have a track record. So we don't just invest for a commercial return, David, we make development impact a central ingredient of that. BII recently, literally a few weeks ago, completed, David, our new 5-year strategy, and I'll just synchronize it into 3 core elements for the purpose of this conversation. The first one is we are now pivoting, shifting completely away from an old model. The old model was about deploying capital, investing in individual transactions, assessing every year, if you like, annual commitments. we're now moving to make private capital mobilization or the mobilization of institutional funds alongside us as our principal activity. So what that means, we want to make sure that we can play a de-risking role, that we can use and create structures in such a manner that we can bring in local pension funds, insurance capital, sovereign wealth funds to invest alongside us. So that's the first one. The second key one is for us to continue to invest, and we have 25% of our roughly $2 billion a year that we invest, 25% minimum will be allocated to the frontier markets. Because if you do this mobilization, what I referred to in the first one, it will naturally, you will have a move towards the more stable, the more middle income countries, the more developed financial markets, for example, of South Africa, Kenya, Nigeria, Egypt. And you will do less investment in countries like Burundi, Sierra Leone, the DRC, and so on. So that's our second key one. And the third and final one, David, is what I referred to at the beginning, which is a deeper, deliberate focus around the role that we play in the ecosystem. In order, for example, for us to be successful in mobilizing private capital, we have to work much more closer and have deeper collaboration with our peer institutions, other European DFIs, International Finance Corporation, Africa Development Bank, private sector arm, TDB, and so on. Thank you.
Brilliant, thank you. Runa, I'm going to go to you next. You've had an amazing career, intimidatingly so when I read your CV. When you think about what's needed to improve or to fix development finance, do you agree with what Leslie's describing? And do you agree with the strategy, or is something else needed?
So I'm Runa Alam. I'm founder and chair of DPI. We manage about $4 billion across Africa. And I have been investing for a very long time, around 28 years in Africa. I have to agree with Leslie because BII invests in our fund. But in all seriousness, I do agree with him. So what we need to raise more capital in Africa is to keep our eye on one thing. Our capital is majority private sector capital, but we also have 14 DFIs in our funds. So for many years, we've been working with both private and DFI capital. The thing we have to keep our eye on in terms of raising more private sector capital in Africa, and frankly, the amount of private capital in Africa versus the GDP is very low. It's the lowest in the world. There's a lot to be done here. What we need to keep our eye on is returns. Private sector, after all that is said and done, what we do, what we say, it's all about returns. And without a high return, which in the private sector world usually means 15% plus net, plus many people tag an Africa premium, which could be as high as another 5%. So these are very high returns. The only exception getting in private sector money without those returns is when there's another reason. So DFIs invest for developmental purposes, but also because there are certain regions they have to invest in. So then the best of the region or somebody who invests in the area that they want to target, they will invest in. The regions of the world that have now decided they must allocate to Africa. When that happens, because our general return most of the time is lower than the global one for the Africa PE industry, then there is money that comes in. Now, I want to be clear that wasn't always the case. It depends on the FX rate. So when the US dollar was low and the African currencies were high, which is around until about 2009, the early 2000s, we were very competitive. You know, our funds were straight up there. So depending on FX, because we're dollar investors, it does matter keeping an eye on return. So what can the DFIs do? Anything that helps with return. That means really trying to think about everything, LPAs, support, everything else, focusing on returns. It's not easy because their DNA and their charter is different. They have to be, I assume, more risk averse, lower returns, but also don't want losses. So, but that focus on returns is important. In the LPA, in maybe allowing additional debt, in creating debt for our companies across the continent that's very little. That gearing up gets returns. That's just one example. Another one is something that can be innovative, which is not first loss. First loss, the amount is usually low globally. And for large funds like us, it doesn't matter unless it's a new fund. But enhancing the return. Is there a structure where they sit behind a certain minimum return that enhances the return so a bigger group of private sector will come in? So I'll stop there.
That was a brilliant answer, thank you. Admasu, can we move to you? TBB is a wonderful example of an African-led development finance institution, which I imagine gives you a different perspective. What's your sense on this question of what's needed in development finance today? What needs to change?
Yeah, well, thank you very much. For those of you who don't know, TDB stands for the Trade and Development Bank. We're a group. We have a concessional window. We have a conventional banking operation. We have an asset management platform with several funds. We are 40 years old and we cover about 30 African countries. Just quickly turning to the topic of development finance, I think you said what can be done to make it better. And I think the one thing that we've all agreed in the past few years is that there's a volume challenge, because we all hear the big gaps. Every conference you go to, the one thing you can be assured of is you leave with a very impressive sense of the gaps in financing. And we know that when you put all the private finance and development finance together, there's a lot to be done. And I think there's a realization that the world has gone through very difficult times of late, ever since COVID. And clearly, the flows of finance to Africa are proving to be much more challenging than they've been in the past couple of decades. And I think the feeling is that development finance needs to pull up its sleeves and do much more. There's a volume challenge that we're all trying to respond to. We all came out of a big conference last year, 2025, in Seville, Spain, where the discussion was global development finance. And it was a perfect time during a time of polycrisis to say, where should the asset class go? And you know, there's different segments. I think Leslie really talked about the strategic perspective from a very important, you know, country-based DFI like BII. You have MDBs who historically have had very unique balance sheets. As you all know, these are, of course, multi-country finance institutions. They have something called callable capital, which typically national DFIs don't have. And when you look at the way in which volumes are considered, when you look at the leverage of MDBs, they don't take into account this giant source of financial commitment that sits behind the balance sheet. So this is one realization that's occurred, that if we were commercial banks, if you look at MDBs, they typically leverage 1 to 3, 1 to 4, maximum 1 to 5. Commercial banks, for those of you who know how Basel works, it's at least double that. Even though it's getting more conservative, it's still much, much more. And they don't even have callable capital, commercial banks. So they leverage 2-3 times what MDBs do, and they don't even have this huge resource called callable capital sitting behind the balance sheet. So there is a sense of lost opportunity in the industry that we're not seeing enough volumes come through. Thank heavens, the understanding is now maturing, and so there's a lot of discussion around relaxing some of these self-imposed conservative constraints, and there's now an agreement in the industry to triple lending between now and 2030. So you're talking about $390 billion of annual lending expected in 2030. 2030 is when the SDG goals come to maturity. We know there's a great deal of slippage. You know, we're running against time. So that, I mean, development finance has done relatively okay, but generally the jury is that, you know, first of all, a bit too conservative, not just on leverage, in terms of the volume aspect, but very much in terms of where it flows. And I was so happy to hear Leslie talk about the new level of appetite to go into the frontier markets, the areas where typically private finance does not flow. And truly speaking, in the end, what you are as a development finance institution is you are a specialized institution that has a public interest to help deal with those jurisdictions that cannot access conventional finance. That's a core economic raison d'etre for development finance institutions to exist. In practice, it's a different ballgame. There was a time a few years ago, I won't mention the institution, but there was one MDB that would not touch a counterpart that sat in a jurisdiction that was BB or less. Now imagine that. I mean, we're all here talking about Africa. How many African countries are BB? All right, most, I think you can count them on one hand, those that are above BB. 50 jurisdictions that are that are below BB. And you have a global MDB that could have had that kind of posture, saying that you're untouchable, so to speak. So there is a real problem around risk. I mean, this is just in terms of geography and ratings and level of development. But if you move into the product range, there's also a risk averseness problem, and that is about, playing the important role of unlocking transactions upstream. Again, it's a topic that's not new, but typically we have a huge problem where there's finance supposedly that is limitless, that's looking for a home, including in developing regions, but this finance is too, they can't find bankable opportunities, right? So this is where you find many development finance institutions these days creating special purpose vehicles, trust funds and the like, to actually do that early stage heavy lifting, right? This is where you need to be able to walk away if you've put a couple of $1 million into studies and the studies indicate that the deal is not going to work. And you need to be able to walk away. So really, it's not just a volume challenge we have, it's a character problem. The character is about risk appetite. I think, the BIIs of this world are stepping up very strongly. I think the World Bank Group has done the same, I must say that, because these days I'm doing a great deal with both of them. I have a lot of LDCs in my region, in Africa. I mean, I think Leslie's talked about the South Africas, Kenyas, and Egypts. But in between those, you have the others that he has mentioned. Some of them are fragile economies coming out of conflict, but still they need to be dealt with. You can't just say, okay, well, when you're finished being fragile, come talk to me. The truth is, this is total market failure and government failure on top of the market failure. So this is where institutions like us have to go in and help pave the way and build some confidence for others to come in. Some of these are very large population countries, right? So there's a lot of work cut out for us. We need to be innovative. We need to start responding better to the real challenge. So comfort zones, a problem.
Comfort zones, a problem. A lot to unpack there, and I think we're going to come back to some of those issues. But I want to move to you, Banji. AFC has been really successful in raising international capital, so you've obviously overcome some of these challenges. Be interested in your perspective again on what do we need to do to make development finance work better?
Yeah, thank you. My name is Banji Fahimtola. I'm ED and Head of Financial Services at Africa Finance Corporation. So I was thinking I had to introduce AFC, but if you look up there, you see AFC makes my life easier. I think my fellow panelists have said a lot already about the world and the reality that we face in the MDB space. And I feel like, one of the words you used was innovation. We need to be more innovative. And I was at a different panel many years ago, and I said, most of the time when MDBs are speaking, you don't use the word innovation and MDB in the same sentence because people thought MDBs were not, innovative, organizations were not fast enough, et cetera, et cetera. But I think that narrative has changed, at least in the case of AFC, because clearly, first of all, our construct is such that we are a PPP, so there's private sector capital in our capital structure, plus government capital, both doing development finance. And we've always believed that no matter how big we grow, the size of the problem continues to be big, and we cannot solve it alone. So we need to crowd in private capital. So every day, when we are thinking, we're thinking, how do we unlock private capital? And that's global as well as domestic, right? If I'm thinking global capital, for example, one of the key tools we have, he mentioned project development. One of the key tools we have is the benefit of a solid credit rating, right? We are rated A by S&P, which makes us the second highest rated entity in Africa. And if you think about the average rating of most African borrowers or sovereigns, we're probably 5-6 notches above them. So how do we bring that rating into play in order to de-risk opportunities on the continent? So we do that primarily by guarantees, as an example, and credit enhancement. Now we do that hard currency, we do that local currency, and there are so many practical examples of where that has been beneficial. So Egypt went through financial crisis many years ago. They needed to tap the capital market. The market was short, and we were able to guarantee a samurai bond issuance for Egypt, which actually made them to issue a bond at about 800 and something basis points inside their dollar curve, and access markets in a difficult time, and crowd in Japanese liquidity. We've done something similar for Angola. We've done that with Bank of Industry in Nigeria, where we did €1 billion first time, and then the second time we did €2 billion for them, and they were able to crowd in new capital from all over the world on the back of a solid AFC rating. So I think for us as MDBs, this is very crucial. Sustaining the quality of rating we have is so important, and as we all know, we're all MDBs, the rating depends on so many factors, the capital, the leverage, etc. So it's very important that the people providing the capital to back these MDBs are actually providing the right quantum of capital, the right type of shareholder support, and even the African sovereigns also have a role to play to ensure that the African MDBs are properly capitalized, well-run, because when we do go out there, we are able to de-risk opportunities for them to attract private capital into the continent. So I think, broadly speaking, those are some of the things we're doing. Guarantee has been an awesome way for us to help, and there are so many other things that we're trying to do as well in terms of advice and trying to unlock the domestic capital pool on the continent as well.
Thank you. Very compelling. Kwamina, can we move to you?
Sure.
I think, and the perspective I had at the beginning was that domestic capital is going to have to be a core part of the solution. As someone who thinks a lot about that topic, can you talk a bit about from where you sit, what you see, the need for changes in development finance to help on particularly domestic capital mobilization?
Sure, thank you very much. My name is Kwamina Asmani. I'm the Chief Executive of Stanbic Bank. Stanbic Bank is part of the Standard Bank Group of South Africa, Africa's largest lender by assets and market capitalization. We're headquartered in Johannesburg with presence in 22 African countries. So commercial banks occupy a very unique place in the global finance ecosystem. We see ourselves being right in the middle between global finance and local opportunity. And granted, development finance institutions provide vast sums of capital to the continent. But oftentimes, these entities don't know the clients as well as we do. We bank them, we bank the entire supply chains, we bank the ecosystem. And what that gives us is strong access to intel and insights, and to the extent that there can be much greater collaboration with us and with governments to unlock greater opportunity, that will be welcome. We're seeing some seismic shifts in the financing landscape with digital fintechs, with mobile money operators. Parts of the economy that were excluded from finance are now have access, opens up lots of business opportunities, and it's changing the way that banks operate, and I believe it must change the way that development finance institutions operate so that they can unlock further capital. We're also seeing further concentration on pockets of women-led businesses as well as youth-led businesses. These are specialized areas that provide new opportunities for both commercial banks and development finance partners to unlock. However, our experience has been that development funding comes obviously at a much lower cost, much longer tenor, but the bureaucracy and the time it takes to get funding oftentimes results in opportunities being missed. There's also greater need to partner with governments to de-risk the landscape. Most of the businesses deal with cyclical demand. Most of the business deal with, high volatility in foreign exchange. And so the ability to unlock more domestic capital, which is local currency. Most of the development funding comes in FX. I would feel that rather than focus on providing capital in FX, which introduces FX risk, if greater effort is expended to build capacity domestically, to deepen capital markets, not just at the primary stage, but also at the secondary stage, to help investors manage their risk much better, that unlocks local capital, makes it more resilient as you go through the cycles.
Thank you. Okay, those are the softball questions. We spice it up a bit. Leslie, back to you. You'll be pleased to hear. So we've talked about private capital mobilization for years. Numbers are still not where they need to be, really. So I suppose my core question is, are DFIs being asked to do something that's structurally unrealistic? And relatedly then, how far can DFIs really go? What else do we need to see?
David, the pivot towards private capital mobilization is at least a decade old. So let's start there. There's been considerable innovation over the last 10 years. Blended finance in its modern current form was probably born around 10 years ago or so, although it existed before, but in a more mainstream form. So we have experimented, we have created a lot of bespoke artisanal structures, if you like. We are now really looking at how we can scale, how we can create greater standardization, and how we can, if you like, have repeatable structures that are not once-off individual bespoke deals. So the first point to make is that there is uniform consensus across the industry that we need to find ways to have deeper forms of collaboration amongst DFIs, because if you think about it, for us to mobilize domestic pension funds, we'll be running around chasing the same pension funds, so whether it's the National Pension Fund Scheme of Zambia or the Kenyan Social Security Authority or the Egyptian or Nigerian, all of these large pension funds will be overwhelmed by meetings with BII, FMO, IFC, and so on. So there's a much greater sense of appreciation now that there has to be a much stronger collaborative approach to it, right? So this has already started, and I'll give you a few examples. Recently, about 3 years ago, BII put in place a fund called GIP Ghana, Growth Investment Partners Ghana, which was really focused at dealing with the financing gap of SMMEs. Small businesses, as you know, constitute the largest contribution to GDP in most of the African continent, and a lot of the small and medium-sized enterprises who need growth capital in the sort of $500,000 to $5 million range, they find great difficulty because of the risk averseness of the formal financial sector. So there is a major financing gap there. So what BII did in Ghana, and what we also did in Zambia, we set up a funding vehicle that is specifically and uniquely catered to deal with that market failure. What's innovative about what we've done there is we were able to crowd in the local largest pension fund to co-invest alongside BII. Most pension funds cannot do greenfield investments. The trustees are not allowed to do that by regulation. But because of BII's track record and because we set the vehicle up, it was not a greenfields as in asking NAPSA, the biggest pension fund, to invest in a startup. We created it and we took the upfront risk and with that de-risking, we were able to bring in NAPSA, we were able to bring in other DFIs, specifically a SVET fund, the Swedish Development Fund. So now we've created a $70 million fund that will provide over the next 15 years up to $300 million of financing for small businesses. And in that way, it will have a massive sort of job creation outcome in Zambia. What I'm saying is that, well, 3 weeks ago I was in India. India is one country with as many people as the entire Africa. Unfortunately, Africa has the encumbrance that we have individual countries. India has the advantage that it's single regulatory frameworks, single sort of consistent policy regimes. Africa is a little bit more complex, which requires us to have more coordinated approaches. I guess what I'm saying in short, mobilization cannot be a competitive sport where each one of us go to these markets by ourselves. We need to come up with structures that can enable pooled vehicles where we bring in others in a more scaled manner.
Thank you. So, Runa, I'm going to ask you whether you agree. You talked a lot about returns. So I suppose my core question is, can blended finance ever actually scale sufficiently to answer the kinds of questions that we're asking?
If you don't mind, I'm going to pick up on a few things that were said and definitely address, as you asked, what Leslie has said. I actually think what Leslie has said is spot on. And I want to go back to first principles. There's $300 trillion of private sector money in the world. It dwarfs every other sort of financing. And it's not just DFIs. It's everybody who's looking at that. This is the future of development. I sit on the board of CARE, 80-year-old organization, similar to Oxfam here, and the revenue model there is going to become focused on the private sector. It's already becoming, and on one other thing, digital and AI. So the world is going in this way, and it's good that development institutions, BII, are pivoting that way. Our whole industry was started by DFIs, and we keep coming back to the well, say, can you please help us? And I do think it's absolutely spot on. The idea, mobilize capital. Where that capital won't go, the DFIs go there. And then also the other innovative part that you discussed, Leslie. So one other thing I want to pick up before I answer your question, which is that local capital. So over the last 20 years, Africa has really developed local capital. Now, is it where it should be, or is it where it will be in 10 years? No, and this is the good news, it's growing. So in our fund, we have now plenty of pension funds from Africa, and each year we see that growing. And this is a natural thing. Pension funds weren't allowed to invest in first non-government entities, then listed, and finally alternatives. Then it took a while for the expertise to develop because they are fiduciaries. They can't lose their pensioners' money. Now they are there, and it's only growing. And so with what I've said, the key to all of this is collaboration. It's collaboration amongst all of us. You talked about collaboration amongst the DFIs. That is very important, especially because it makes, if you have standardized things, it makes everybody's lives easier. It's much more efficient. But it's also collaboration amongst DFIs, the intermediaries, the funds, private equity, venture capital, but also with the banks and with everyone else, because the structures that we're talking about will take many, many entities to do. And then to get to the ultimate point, which is investment and development, we have to collaborate with the entrepreneurs, the companies in Africa. So this was brought out also in a previous panel that Sanjeev hosted on philanthropy. So the word is collaboration, and we have to think about, this is good, we're talking, but how do we convene to make those collaborations happen?
Thank you. This is a fascinating discussion, and we are starting to run short on time. So I'm going to ask, I think, the same question to our next three panel members, which is really about, as Western bilateral DFIs reorientate, as Leslie said, in some cases retrench, what is it that African-led institutions need to step up further, to play a bigger and more substantive role? So Admasu, if we can start with you, and then we'll go sort of along the line.
Yeah, so I think on this issue of trying to really better respond to the gaps are very big. We've issued hybrid capital. That is a recent initiative that several in our industry have been pursuing. It's something that credit rating agencies have very warmly embraced in recent years. That allows us to attract also private sector investors into our own balance sheets in a way that was not possible in the past. So that is one thing that we're doing, and we're trying to do that to scale up. We're also trying to step outside of the normal course of conventional financing to really help scale up what Leslie and others refer to as blended finance being such an important thrust to help de-risk and, of course, set the stage for much more financing to come in. So we've set up a concessional and grant-making entity within the group called TDF. Trade and Development Fund now does results-based financing with strategic partners where we're able actually to incentivize our clients, private sector companies, giving them literally grants for every connection made in a rural or very remote area where normally their business models wouldn't allow them to go. So this is a classic way of doing this in terms of blended finance. This is part of the Mission 300 initiative that we're working closely on with a number of strategic partners. And of course, the kind of work that we've heard from DPI, Rulam has talked about funds. One of the things we've realized is you can also help attract more funds by subordinating yourself even more deeply than taking a simple position of risk capital. We've now taken a junior equity position in a new fund that will actually help attract potentially institutional investors into senior equity. So we're used to talking senior debt, subordinated debt, and equity. Now there's a new tranche of junior equity that's coming in that's going to make it easier for even the private sector to come into senior equity. I mean, these are innovations that we're doing to try to really, truly innovate and not just try to be volume players, but to be catalysts and to help draw in the bigger volume of capital that's out there. We have a trade finance fund that's about $500 million. It started just about 4 or 5 years ago, and many of my partners thought it was my $500 million. My money was 50 million. The rest of the 500 billion is coming from pension funds, insurance companies, and other, even high net worth individuals are coming into this. And we've had it rated. It's a AAA rated trade fund, one of the largest in Africa, based in Mauritius. And we've now gotten a rating in Japan. We have a rating in China. And the whole idea is to attract various types of institutional capital without using our own money. The idea is to do more with less. So it's all about this whole question of attracting more to come in. And we now have 4 funds under management, under our asset management platform, and it's been very positive. Our NPLs are well below 1%, highly rated, and very good returns. And so this is where, as Africans, we're very, very keen on the intra-Africa trade side of the development agenda. This is what you were asking. What makes you a little bit different from the other DFIs or the global MDBs? Well, as Africans, we have a very strong remit to push what we call Agenda 2063. It's the intra-Africa trade agenda. It's the transformation around infrastructure that creates larger markets, but infrastructure that allows transformation to happen so that actually we can start realizing the dream of more value addition. Jobs, SMEs, very important, like Leslie said, but even SMEs sit on an operating framework. If there's no power and transport that's cost effective, SMEs will never be able to scale up.
Thank you. I want to make sure that Banji has time to come in. So Banji, what's your perspective?
Yeah, a couple of points. One, I think the African MDBs, we all need to collaborate on several areas, but importantly on project development, because I think we all need to find a way to make our projects to become more bankable. Extremely important. We can't run away from that. So I think that's an important point where we need to focus on working together. And I think we can take that one step further, right? By actually now more or less putting our money where our mouth is. So I give you an example. If you're doing a typical project finance, you know, lenders don't want to come in because they're looking at the risk. Construction risk is a big issue. And we figured out that one of the best ways to de-risk a project could be for us to do an all-equity construction finance and get the power plant running. And once the cash flows are there, global capital starts to pour in. So I think as African MDBs, we need to create those projects and opportunities, de-risk them, and then all of a sudden, we'll start to see significant capitals coming in. One last point maybe I'll just add to that is something that hasn't worked well, in my opinion, is we've been so fragmented, doing small projects here, while not connecting the dots. So this is the time for us to start thinking about how do we build scale in infrastructure. So projects become more attractive to international capital and private capital when you have the right scale. People don't want to put money in a $5 million, $10 million project. But if you bring a $1 billion project, people pause and they want to talk, right? So I think this is something we need to think about the entire ecosystem and start creating platforms so that we can build those big companies, those big projects that can attract global capital. And it's actually us that can do it as the MDBs.
Thank you. Well, perhaps appropriately then, final word to the private sector. Kwamina.
Sure, thank you. So as you look at the opportunity set in Africa, and I agree with Leslie, the greatest opportunity lies in SMEs, and SMEs would also provide opportunities to diversify. One of the ways of managing the risks on the continent is to diversify quite extensively, and SMEs offer that advantage. However, they do come with a big constraint, which is that their equity bases are typically either non-existent or very thin. It speaks to one missing piece in the finance landscape in Africa, which is the venture capital space. It's the missing middle. We do have commercial funding in commercial finance in abundance. There's DFI financing focused on that on the continent. What we're missing is the venture capital, which serves as, you know, the bedrock for most of these SMEs. And so if we can work towards getting more venture capital, you know, angel type money into the continent, it makes these opportunities a lot more bankable. I did speak earlier about the need to mobilize domestic capital. Quite significant funding coming from diaspora. The diaspora is a big source of potential funding through the remittances that come through. And then the need for also to unlock a lot of the private pension funding that is available.
Thank you. My notes say thank the panel to rapturous applause. So thank you.